Taxes are boring and international taxation is very complicated, but it pays off so big time to know your way around that topic. Why is it important? Think of it this way. If this is your lifetime income, let's say 5 million US dollar, you have to pay taxes on it. So you get, let's say, 3 million and 2 million you have to pay taxes, so that's not yours. That's not too bad, but if you can reduce your taxes by, let's say, 50%, so you don't pay 2 million but only 1, so that's 33% more income for you after taxes. And to get 33% income after taxes, that's like getting 50% more income before taxes. That's something like this. So how difficult is it to get a 50% pay rise? And how difficult it is to optimize your taxes a little bit? And now think of it like you reduce your taxes completely down to 0. That's including the progression of your taxes, more like doubling your income gross. Now, I'm not saying you should reduce your taxes to 0, but there are other ways where you can basically borrow money from your taxes and make additional income by investing that money. Deferred taxation I'm talking about. So you see, it really pays off to optimize your taxes. That sounds quite attractive, right? But it gets even better. Let's look at just deferred taxation. You're familiar with schemes like 401k, or every country has some kind of retirement savings plan that has a deferred taxation built in. So every month, every year, you save some money in this plan. You don't have to pay taxes on this part of your income. It's locked away, but you can invest it. And typically, that's most of these cases, the idea when you are retired, when you're 65 or something, you get it and then you have to pay taxes, either the regular taxes, but probably on a lower tax bracket, or even a reduced tax rate altogether. Now, you might say, okay, I have to pay taxes now or later. Either way, I have to pay taxes, but it makes a huge difference because you get the compound interest of investing this money for decades. And that, in these numbers, 5 million lifetime income and 3 million or 4 million after taxes, that can add up to something like another million. So 1 more million after tax. And now you're already at 5 million lifetime income. So you see, it really does pay off to know your way around. But still, just deferred taxation might not look that attractive to you, but keep in mind, there are ways where you can defer indefinitely, forever. In theory, you just postpone it, but the day that you pay taxes will never come. Think of, for example, Bill Gates and his Microsoft shares. He had them over decades. The value of these increased a lot. If he had sold them, he would have paid taxes on that, but he never sold them. And instead of selling them and paying taxes at a later point of time, he just transferred them into a foundation, and it's not a taxable event, so he did not have to pay taxes ever. That's how all the big billionaires do it. Elon Musk, Jeff Bezos, all the same scheme. But these schemes don't only work for large companies, founders of billion-dollar companies. It's not just equity. It's also real estate. And there are also ways on the equity side where you can make these schemes available for a retail investor or someone who's not a billionaire but has a little bit of money. So you can do the same what they do in their Microsoft or Amazon shares, you can do with an ETF. So for example, an all-market ETF, broad index fund, or Standard & Poor's 500 index fund. You buy it once, you never sell it, maybe you get a bit of dividends, which you have to pay taxes, maybe. There are also funds that never pay dividends, and the value increases. So you wonder, if I never sell it, what's the benefit for me of owning it? Well, you can use it as collateral for a loan. So at some point you have a big chunk of money in this ETF and it has not been taxed ever, but you can use it as collateral. So you can put that to a bank. These days, these types of loans are available also to retail investors. So you can use that as a down payment for your mortgage, or even to, well, buy a car, buy a yacht, airplane, anything. You can use it nearly as good as money. At some points, even 70% loan to value, sometimes even more. So you don't have to sell it, and that's why you don't have to pay taxes on it. If you want, never. Real estate is actually similar. You will see in pretty much all asset classes, there are ways to defer the income, the taxation. Real estate is a big one where this is common. So you buy a house, you rent it out. In the early years, you have a lot of depreciation, so you're not really making any net profit on that. Later in life, or in the ownership duration of that property, you actually make profit. Maybe even you sell it and then you make profit, but that will be in far distant future. And these may or may not be taxable events, depending on where you are. So you see there's a lot of room to optimize your taxes, and it has a huge impact on your net income. Now, I looked so far only at one dimension that you can optimize, and that is time. You can basically move your income from one point of time to another. That might also be that you have some income that you only get in the coming year or the coming years. So you can push it in the future. There are ways, there are scenarios where you might want to have it earlier. In most cases, you want to push it into the future. But time is only one dimension where you can move your income around to benefit from the best taxes. There are primarily three dimensions that you should look at to optimize your income. One is time. Push it into the future, or maybe even never. Another important one is location. It's mostly by country. So if you're floating in the middle of the Atlantic Ocean, there's no territorial waters, no one will tax you. But chances are that's not where you're spending your life and where you're a citizen of. So talking about citizenship, technically a few years ago there were only two countries in the world that taxed by citizenship, and that was the United States of America and Eritrea. Now there are few more countries, and as people are getting a bit more mobile and moving to countries that are tax-wise more friendly towards them, more countries are considering taxing by citizenship. So in the United States, for example, citizenship or even a green card will make you taxable in the United States. If you're a US citizen and you live in Canada or wherever, you have to pay taxes to the United States based on your income. So that's based on citizenship. Most countries tax differently. Most countries tax residents, so whether they're citizens or not. So if you live there for a certain number of days and are registered and have a residential address and all that, the criteria are slightly different for each country. In that case, they will tax you, and often on your world income. So let's say a US citizen lives in France, gets rental income from Spain. He needs to pay taxes on this rental income in Spain. He needs to pay taxes on his world income in France, and to some degree in the United States because of his citizenship. Now, there are a lot of countries that tax you by your territorial income. So let's say you live in Paraguay. You have to pay taxes on the income you earn in Paraguay, but not the income you earn in Argentina, for example. So that's territorial, based on your residency in that country. And then some countries have a bit of a mix, like for example the Philippines. They tax their citizens on the world income, but foreigners who are residents in the Philippines are only taxed on the territorial income. So it's a wide variety of nuances here, and you can pick and choose whatever suits you best. Try to get a residency, live there, whatever. There are even ways temporarily to have no tax residency at all. So that can happen if you're a perpetual traveler. You do not have a residency tax-wise anywhere, so you don't have to pay taxes anywhere. Well, that's a very, very rare case and hard to really make that happen. Now, talking about taxing on world income. World income is a vague term, and every country taxes slightly different. So obviously, if you're an employee, you get a salary that you have to pay taxes for. But already when we're talking about capital gains, it gets a bit more nuanced. So let's say you get a dividend. You have a share, you buy a share for $100. Next week you get $5 dividend. And 1 week later you sell it for $95. Did you make a profit on that? Depends who you ask. So in many countries, a dividend would be taxable income. So you have to pay taxes on these $5. Now you have a loss of $5 when you sell it. You may or may not deduct that and value that off, right? So logically, you did not make any profit with that investment, but you still might have to pay taxes, depending on where you are. So it might be that, let's say you buy a share for $100, you get a dividend of $5, you sell it for $110. These $5 and the $10 of appreciation that you realize, this capital gain and the dividend capital gain, are different types of capital gain. And some countries tax only dividends, but not realized profits. So also here you have to look at that in a lot more detail. With these nuances, it can be interesting to own shares that don't pay much dividends, but you have more capital gains in the appreciation of the share itself. And when you want to sell it, either you never sell it at all, or at some point you move to a country where you can sell it without being taxed on this one. Also, when it comes to different jurisdictions that tax a dividend and that tax the capital gain upon sales, it's very different. So let's say I live in Germany and I own a share of Apple. Apple pays a dividend. A part of that tax needs to go to the United States, and a part of that tax on the dividend goes to Germany. Now, when I sell the share and make a profit, this profit is only taxed in Germany and the United States, which is in the picture because Apple has its headquarters in the United States. On the capital gains, on the appreciation and realizing these profits, the US are not in the picture. So you see, this is a very wide field, and I made a couple of examples here on equities, shares, of course ETFs, very similar, but properties, real estate is also kind of similar. Now, property or real estate, of course, is tied down to one country, so you cannot easily move it around. Let's say I own a house in Switzerland, but I live in Singapore, and I sell that and realize a profit, I have to pay a tax on that profit in Switzerland. Singapore itself does not tax my capital gain realization because they only tax on territorial terms. So overseas income is not taxed. But then, of course, if I live in France, sell a house in Switzerland, same circumstances, I might have to pay in both countries tax on that. Now, there are a lot of ways to actually benefit from these, right? So, for example, you have a pension fund or something like that. Lots of different schemes in the world. And often you have to pay in with the idea in mind when you retire, you get that. Let's say you have to be 65 years old or whatever it is in that country to get money out. Very often they have a clause that if you leave the country permanently, you can access that money. Maybe based on some reduced tax rate or whatever it is. The nuances are very, very different. It can happen that the country you're moving to will require taxation. For example, you have a pension fund in Switzerland and you move to Germany. You can't pay out at least parts of that pension fund when you leave the country permanently. So you have to pay a reduced tax rate in Switzerland, but it's very, very small. And by moving the money to a different location within Switzerland, you can even reduce that further. But Germany would require a tax on that because they tax on world income, and getting this deferred income from the pension fund would be taxable in Germany in that year. So that's in some cases prohibitive. So you would not get that pension fund money out, you would just leave it where it is because the tax is just too high. Now, in the same scenario, you have a pension fund in Switzerland, but you move to Dubai or Paraguay, Philippines or Singapore, and you get it out. Then you have to pay a tiny, tiny tax in Switzerland, but nothing beyond that, nothing in the location that I just mentioned, like Dubai, because they only tax within the territory, and this income from getting that pension fund out would take place in Switzerland in this case. So there are multiple ways to make use of moving income from one country to another, moving your location from one country to another. And of course, you can have companies in different locations that shelter that by owning an asset. And for example, you can have a company that owns, let's say, a property. If you sell the property, you would have to pay taxes on the realized gains, but the company might be in a different location. You sell the company that owns that asset, and tax-wise, it looks very different. So a location is complicated, typically more interesting if it's a 6-digit amount at least, but beyond that, location is a big topic. Then, of course, time and type of income is across the board super interesting. Different countries, different taxes. So depending on where you live, you might live in a high tax location, but also the different types of taxes are different from one location or country to another. So there are countries that do not have a personal income tax. Now, probably you don't want to move around every year or every second year to a different country just to optimize your taxes. Totally get that. But you might be in a situation at some point that, let's say, you have to get money, you want to sell some real estate, whatever it is, you have a big chunk of equity you want to sell, but the taxes would kill you. So you can move to a country where this event is not taxable, stay there for the amount that is necessary for all participating countries in the setup to be happy with that. Then you can sell it without paying any tax and move back. So at some point you might literally get paid $500,000 or more just to live in Dubai or in the Philippines for half a year or whatever it is. So that is the other dimension of the location. And of course, you might not even have to live there and move there. It might be possible to just start a company there and the company holds the assets, something like that. So you can transfer your incomes to a different country and maybe you can just leave it there, or you get it in a different time or in a different way back to yourself. Now there's a third dimension you should also look at, and that is the type of income. Think of an employee. He only gets employment income, can't do much about it. But think of a freelancer. He can start a company. The company invoices his clients, and from that money he can pay himself a salary. But he doesn't have to, or he can pay a little bit of a salary, but when the company makes a profit, it pays out a dividend. That is a different type of income, and the tax rate might be different as well. So it might be that there's 40–50% on the income from work, but only 15% on income from dividends. And there are other types of capital gains as well. So for example, you can accrue the value within the company and the value of the company goes up. But if you don't sell that company, it's not a taxable event. So you don't have to pay taxes on that either. And again, also here, it's a scenario where maybe at some point in your life, you have to live in the Philippines for half a year or wherever it is where you don't have to pay income tax on this specific type of income. So you have these three dimensions: time, location, and the type of income. And with these you can play around. You can move income along the time axis. You can move it to a different country where a different income type might be even tax-free. So for example, you have an income stream in country A, you move it to a company in a different country, and there it's paid out as a different income type where it's not taxable. So these are the three dimensions you can look at. And that is a scheme all the big billionaires like Elon Musk, Jeff Bezos, all of them make use of. So they have companies in multiple locations and they move assets and income streams between them. Foundations can be part of that picture as well, but also for a retail investor or a more normal person, there are a lot of possibilities where you can optimize your income taxes. And every time you plan an investment or you structure your portfolio, be it equities or real estate, anything like that, do consider the impact and what are the options you have to optimize the tax implications of your investments, of selling anything, which might be a taxable event, or getting income from your property or from your equities. Now, if you want to start simple on this topic, make use as much as possible of deferring taxation possibilities, like a 401k or anything like that. Real estate can also be used for that. Rarely sell anything if taxes are applied. And get comfortable with using your assets as collateral for loans, so you avoid the taxable event of selling it. Now, having said all that, I'm not a tax consultant, so I'm not giving tax advice here. I'm just trying to explain generic concepts. Whatever scheme you're actually going with, be very, very careful, understand what you're doing, get the tax consulting that you need to be sure that you're on the legal side. It's a very, very slippery slope, and there are a lot of pitfalls you might stumble over. So do get the tax consulting that you need, but do have an understanding of the implications and the possibilities as well.